Welcome back to Econo Chat. Let's talk business with Mr. Daniel Steinman. You are tuned in to the Power Station Energy 100 with myself, Elsa Bitunyani, as your hostess. We had a very interesting question, I should say, before we went on a break. How does the forecast, when it is downscaled or downgraded, how does this affect the private sector?
Elsa, excellent question. Because this comes down to performance on investments. So the Bank of Namibia, which is the central bank, sets monetary policy.
Yeah.
And that monetary policy, because it revolves around interest rates, determine to a large extent how much additional liquidity you will allow the system to generate.
Okay.
Now that is a mouthful, I know. Let's put it in very simple language. If you allow liquidity to grow at a certain rate, it means that you are stimulating the economy.
Yeah.
And there are various ways that you can make liquidity in the local banking system bigger or increase liquidity. But liquidity is what you need for banks to be able to extend loans.
Yeah.
So you first need liquidity. Only then do you come to the investment side, where people actually borrow and use that money for something. So the Bank of Namibia, as the patron or the guardian of the banking system, is also the guardian of our money. So they would want to, their model will tell a higher growth rate, expected growth rate, than what the private sector's model will tell them. And I'll come to that just now.
Yeah.
Because it has a lot to do with confidence. But it also has to be credible. If the Bank of Namibia tells us we're going to grow at 6%, everybody is going to laugh. 5%, we will still find it funny. 4%, wow, nice, maybe, but let's see.
Yeah.
But if the Bank of Namibia, applying the variables that they work on through their model, come up with a 3.8% or a 3.6% GDP growth rate, it's a very reliable figure, or it's a very credible figure. You can sell that figure to the market.
Yeah.
The private sector, on the other hand, remember I said one of the three functions is that they do investment. They take your money on your behalf and they go put it in a big mattress somewhere, you know, and they guarantee you a certain return. Now they very, let's say, we call them wealth managers, and all the big insurance companies has a wealth, whether it's Metropolitan or Sanlam or Old Mutual or PSG, anybody that, or Capricorn, anybody that handles the investment of funds on behalf of retail clients, they also have a house view, but theirs will be conservative.
Okay.
Because remember, they get your money by convincing you that they will generate a 3.4% return on your investment.
Yeah.
If they don't generate that 3.4% return on your investment, you become very upset. And what do? You close your account, you take your money away, which is what they want to avoid at all costs.
At all costs.
So do you see this disparity? Bank of Namibia, they're concerned with confidence, but it must be credible.
Yeah.
And the private sector, the wealth managers or the investment companies, they are concerned with what sort of guarantee they cannot promise. They will never promise because they know that they don't control it. But what indication of a return on investment that is reliable or realistic can they give to you as the investor? And so they will always use a more conservative model. They will always come in with a lower figure because it's much safer to say we expect GDP growth of 2.9%, and at the end of the year or next year, February, when they send you your investment statement, it actually comes out to 3.2%, because then they make a big spiel of this, you know. All the marketing's perfect. We see we outperform the market or we outperform the benchmark and blah, blah, blah. So can you see that we're talking about two different mandates? The Bank of Namibia has a certain goal that it wants to achieve with the information that it gives out. And the private sector, they want to attract investors or clients, but again, that whole credibility factor becomes very important. If you've got 100,000 Namibia dollar available, I don't. I hope you have.
I speak it into existence.
Instead of sticking it into your mattress, now you start browsing the websites of all the investment management companies, the investment managers in Namibia, and you see, you look at historical returns, what they can prove, this is what we generated in the past, and then you see their expectations. Now, remember, I'm talking a lot about credibility. The higher figure or the bigger, higher model of Bank of Namibia must be credible. The lower figure of the private sector must be credible. If they only promise you or give you an indication of a 2.2% return, and everybody else talks about 2.8, 2.93%, where are you going to take your money?
To the highest bidder.
To the highest bidder. So do you see there's a whole lot of psychology in GDP forecasts. And people who are not involved in economics, they think it's all sort of rational and you can work this out with a mathematical formula. You can't. That's the reason why they call it a house view. It's basically, it's intelligent guessing. And don't get me wrong, I'm not saying that it is unfounded guessing. But any analyst that works with the future, and this is what you do when you're forecasting, you're working with the future. They will always advise you to be very humble, because you don't control the future. But they also realize that there's sort of a line below or a value below which they cannot go, otherwise they do not attract clients. If they are too low, then immediately you see it. If you compare a number of institutions, you see that the returns are actually very, very close together. So if their promise is too low, you don't go there. If their promise is too high, immediately you start disbelieving them. If everybody else only thinks they can generate 3.4, how are you going to generate 3.8? So there are natural safety mechanisms built into the system, and it's all based on comparative values.
Okay. And there we have it. On that note, let's quickly go for a short break, and we'll be back after these.